professional investor, called a fund manager, will either manage a fund or an investment trust. Both pool the money of thousands of investors in a selection of investments known as a portfolio. The main difference between the two is that investment trusts are companies in their own right and are listed on the London Stock Exchange. That means that those that invest are also a shareholder. Investment trusts have certain structural advantages over funds. Here we run through 5 of them. Trusts have 2 values: how much the trust holdings are actually worth, called the net asset value or NAV, and the price its shares trade at on the stock market. A trust shares will either trade on a premium when the shares cost more than the NAV, or a discount when they cost less than the NAV. The latter offers investors the chance to buy the shares on the cheap. Unlike funds, investment trust managers do not have to buy or sell assets held in a portfolio depending on whether there's money coming in or leaving the fund. This is because with investment trusts, a fixed number of shares are issued. You may see this being referred to as a closed-end fund. With actual funds, the size of the fund is influenced by whether investors are buying or selling. If there are more buyers, the fund manager will go out and buy more stocks, more sellers or redemptions, and they will sell stocks that they own. You may see this referred to as open-ended. Funds have to give back to investors all of the dividends they receive from shares each year, whereas investment trusts can hold back up to 15% each year. This so-called revenue reserve can be tapped into when the companies the trust is invested in pay lower dividends than expected, a dividend shortfall. It allows the trust to potentially maintain or increase its dividend. This plays out during the COVID-19 pandemic. The majority of dividend-paying investment trusts maintained or increased dividends, whereas the majority of funds cut their dividends. Investment trusts are allowed to gear or borrow to invest. This can improve their performance in a rising market. However, it does increase risk. If the market falls, investors in a trust that gears suffer significantly greater losses per share. Another key difference versus funds is that an investment trust typically has an independent board of directors overseeing it and ensuring it is managed according to shareholders' interests. If the fund manager doesn't do a good job, the board can fire and replace them.